Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back. I am in the studio this morning, so if you want to call, 216-901-0945. Number again is 216-901-0945. And I just thought I would start today's show. Oh, lovely. I'll tell you, technology. Have you been noticing, like, your internet goes down a lot these days? Seems to be, we're spending sometimes 3 hours in a day just waiting for the internet to go back up. Do you know how frustrating that is? Our whole life is on the internet. And particularly us, because, everything that anybody does, all my major custodians, and we've got the biggest custodian in the world, okay? And they use, you have to log in over the internet. So it is mind-boggling that something's happening that nobody's talking about. And you know what? We'll probably find out about it once they figure out what the problem is and get it fixed. Then they'll come back and say, "Oh yeah, well it was this," and that's okay. It's okay. But I just want to. I'm going to be talking about a few things today. One of them is going to be the future of Social Security. I get that question quite a bit. At Bullington Capital, most of our clients are either at or near retirement, and that's kind of what we're specializing in. Is how do you plan for retirement? I think I was talking to my mom, and she asked a question. She said, when do you think people should start planning for retirement? And without hesitation, I said 12. I know people think I'm kidding, but I'm not really kidding. At 12 years old, that's when Warren Buffett had a paper route that delivered to Nebraska, Omaha, the whole city. And he was like a broker, and he hired all these other guys to deliver the papers underneath him. And his grandfather was wealthy, and his dad was a U.S. senator, so he never had to play sports to get through college. And he concentrated on money, smart. Realistically, when you look at how much it takes, it's tough. So you just have to do the best you can, and you know what that is. If you're saving somewhere between 10 and 20%. I know a lot of people are going, what? I have to save between 10 and 20%? Yeah. And that's the unfortunate fact of the matter, because it takes an enormous amount of money to replace your income when you're not working anymore. Think about it. Financial planning industry has this rule. They call it the 4% rule. That's the amount that you should shoot for to begin taking distributions from 4% of your assets. So let's say you got $1 million, okay? You shouldn't spend more than $40,000 that first year. And each year or every other year, or however you want to do it, once every 3 or 4 years, you're probably going to have to make adjustments to that 4% because of inflation. And there are inflation articles all over the news media today, so I don't think I even have to talk much about that. But so inflation's going to be there. That's why you start out at just taking 4%. So how do I know what I need to be able to replace my income? Well, get an estimate of Social Security, or if you have a pension, get an estimate from that, then that reduces the amount that you're going to have. But the vast majority of people could get by without even making any major cuts to their lifestyle on about 75% of their pre-retirement income. So if you made $100,000, $75,000, you probably won't miss a whole lot. First of all, you're not going to be saving for retirement anymore, so that you add that money back into your spending. And anybody can cut back, 4 or 5% if they have to. And despite what people say, your expenses typically don't go up. And in the first few years of retirement, oftentimes people will take a few trips and they might spend a little bit more than they normally would. But then you'll make up for that later when you get past 80. My clients who are past 80, they're not interested in, taking that jet out to Las Vegas and spending a weekend and, whooping it up and coming back. That's just stuff that's not happening. At least it hasn't happened yet. I don't know. As soon as I say something, it always comes back right in my face. But anyway, so yeah, you probably, you're a little more content. Energy starts to, go down a little bit. That's okay. I have a lot of clients in their 90s, by the way. And I think my oldest client lived to 101. And that was pretty good. Was healthy, It was a surprise, so that was interesting. But anyway, I know when a lot of people are they get upset. They think this. One of the things I really am not real fond of is the fact that Congress will come out and they threaten the Social Security because they know that there are, I think it's close to 60 million voters that would be affected by that. I'll have to double check that fact, but that's what I came up with, and might be less than that. But anyway, it's a lot. The number of retirees in this country, people that are on Medicare, Social Security, it's a lot. Okay, and people that are getting close to it wonder if it's still going to be there. Is my Social Security still going to be there when I get there? Yeah, it's going to be there, because you know what? No political party could afford to turn their backs on that large of a group of voters. That just ain't happening. So they're going to make a lot of noise about it to try to get something else that they want. And it'll be their compromise, quote unquote. But I even went to, here's a little article I actually picked up on that exact subject. And as a result of the changes the Social Security enacted in 1983, benefits are now expected to be payable in full on a timely basis until 2037. Okay, when the trust fund reserves are projected to become exhausted. Okay, those are just projections. At the point where the reserves are used up, continuing taxes are expected to be enough to pay 76% of the scheduled benefits. Okay, so it's not like it's out of money. People are always paying into it. And so you got to fund about a 24% of that. And let's see, the Social Security Board of Trustees project that changes equivalent to an immediate reduction in benefits of about 13%. That ain't going to happen. Or an immediate increase in the combined payroll tax from 12.4% to 14.4%. Now, see, this is how they do. This is how they get you. And this is what they're going to do. Because when you look at the choices of coming up short, or you having to pay a whole lot more money out of your pocket, okay, to get the same, to get coverage, okay, and they're going to reduce those benefits by 13%. And then a lot of doctors out there who accept Medicaid or Medicare today going to stop accepting Medicare because they're cutting their pay. And instead of all that happening, they're saying, well, we can't just raise the payroll tax. By the way, when you're retired, you're not on payroll anymore. It's not your tax. And you're about a third of the voters. So the bottom line is that's probably what's happening. You're probably going to see a 2% increase in the in taxes to pay. And then you know what? The problem's gone. Or at least it's delayed. This is something that will be going on for the next 50, 60, 70, 100 years. This argument keeps going back and forth all the time. But I just wanted to let you know, if you're out there and you're worried about that, don't worry. It's not worth losing sleep over. I'm telling you, they will make the changes. They rattle their sabers loudly enough for long enough, and that 2% is going to be like, well, maybe I'll take that. Especially since it's not you that's working and paying into it. But the people like me, I'll pay it. I really, is it a lot? Yeah, it's a lot. I mean, it's a lot. But, one of these days I'll be using that program. So I want it to be there. And it's really not that, for the vast majority of people, it's not that big a deal. And so if you want to see this article, if you want me to send you the link, you can go to my website. It's bullingtoncapital.com. And if you go to the website and ask to send the link to that page that talks about the Social Security, by the way, it's on the Social Security Administration. I'm sorry, I was talking about Medicare. It's on the Social Security Administration website. So I can send you the link. It's not a problem. That's Bill at Bullington Capital, or just go to bullingtoncapital.com. There's a contact us page. By the way, I get people, probably, several people a week. They go there, but they don't ask a question. I get an email address and the question's blank. So I'm not really sure what I'm supposed to do with that. What you would want, I don't want to agitate anybody. We're not a low pressure firm. We're a no pressure firm. Okay, we never apply pressure to anybody for anything, and it's hard enough. You try to understand what you're trying to accomplish, what your situation is, give you options that might suit what you want to do. I'll even show you. I mean, if you're interested, I'll show you all the options. And although most of the time, all the options don't apply to everybody. Everybody's got different tastes, and it's really interesting to see a couple sit down and fill out a questionnaire together. And they oftentimes, they're not on the same page. And it's amazing because, they've been married like 25, 30, 40 years. And when it comes to investing, totally different. And not necessarily bad. But oftentimes, they are at odds occasionally, and that's why it's good to have. I think that's why it's good to have an advisor, somebody to sit down. The conversations are just like the ones you hear here on the radio. This is how I speak all the time. If you don't like it, don't call me. And I'm pretty blunt, and I feel like you have to be. There are a lot of things that are upsetting. Just like this Social Security thing. And I've had people come in who got so worked up over this. I mean, they couldn't think straight. They couldn't concentrate and couldn't answer any questions that I was asking them because they were so upset over this. Can you believe that? Thank goodness it's not often, that happens, because those are stressful meetings. Somebody comes in and they're all upset about something that, first of all, they can't control. Secondly, I can't control it either. And so what we need to do is plan around it, make a plan. Well, what happens if this happens to you? What do you think is going to happen in the future? Okay, and what can we do today that would help mitigate that risk? Let's reduce that risk. I'm a big proponent of not taking any more risk than you need to. I just don't think it's a good idea. Making money in financial markets is not easy, especially today. You've got a stock market that is somewhat overvalued. It's probably selling 25, 30% more than it should. Now think about that for a second. It's selling 25, 30% more than it should. Am I going all to cash because I just said that? Heck no. You know why? Because you can't time that up. That's within a range of normal for the stock market. It's normally somewhere between 25 and 30% overvalued or 25 and 30% undervalued, and it doesn't tell you when it's going the other direction, ever. And I guess that's my biggest pain, source of pain in this industry, is that if somebody will read something that they really like, and it's on probably Facebook or actually even in Forbes. A lot of the big publications put articles out there. These guys are not economists, they're journalists. Yeah, occasionally you'll have somebody who's an economist or an investment manager that decided they didn't like that field and goes into journalism. That is very rare. I'll tell you that. So they hear something and then interpreting it is pretty tough. I feel bad for an individual investor who doesn't have a lot of interest in this, because if you don't have a lot of interest, you're probably not going to be able to put in the kind of effort that it takes to get the answers. But thank goodness that's why I'm still employed. And it's I like it. I mean, it changes fast. I mean, every year every 4 to 5 years, when you go look back at how things were 4 to 5 years ago, and then you look at it today, you're going, holy cow, it's amazing. And then you go back 30 years and you're looking at the patterns, and that's kind of like, that's normal. Things are constantly shifting. Interest rates are slightly higher now. And I know some people are saying slightly, I was around when a money market paid 18%. A money market, that's like a savings account. Those were short-term treasury bonds inside that fund. I remember when they paid 18%. That was wild. My grandmother was in heaven. But to think about, I hope those days don't come back, because rising inflation is hard on the stock market. It's hard. Procter & Gamble can only raise their prices so fast that people stop buying Tide or start pouring water into the Tide bottle before it's all the way and you're definitely going to rinse that bottle out before you throw it out. But anyway, so I've got about 60 seconds before I have to take a real quick commercial break. This is Bill Bullington. I'm here every Saturday morning from 11 to noon. I'd advise you, if you want to talk about your own personal situation, feel free to hit me up on my website or give us a call in the office, 330-664-0700. That number is 330-664-0700. And I'm going to, now when we come back, we're going to talk a little bit more about the bonds and what you can do about that. Bond interest rates being so low. Well, actually, they're coming up. You got to be careful, though, because when interest rates rise, not only does it make it hard on the stock market, it makes it hard on existing bonds. If you're not in the right categories, it's going to be very painful. It's already been painful, but there's more pain coming. So we'll learn how to avoid that right after these commercial messages. And I think we should probably be able to go right about now. Well, welcome back. This is Bill Bullington. I'm here every Saturday morning from 11 to noon. If you'd like to reach out and talk about your own personal situation, feel free to go to my website. It's bullingtoncapital.com. There's a contact us form there. You can also just call 330-664-0700, and I'll be glad to try to help you any way we can. And we were talking a little bit about Social Security, and if you'd like, I can send you a link to that page on the Social Security website. And it talks about what they need to do to fix Social Security. And it's completely, totally fixable. Does it mean that there's going to be effort or higher taxes there? For the vast majority of a lot of people, no. They're not talking about raising everyone's tax 2%. They're talking about raising it on certain incomes. So it's a fixable problem, despite what somebody might talk about on YouTube. You just have to be so careful. I read a lot. I watch a lot of YouTube, all mostly related to my business. And I'm telling you, you just have to be careful. And even my show. Here's my advice. Don't believe anybody. Wait until you can have 4 or 5 sources that are going to give you the same answer before you put any weight to it. So if you've got 3 or 4 spots on the internet and you can go in there and put questions in, you should go ahead and do that. Talk to your financial advisor, go ahead and do that. Talk to your tax preparer, go ahead and do that. If the answers are all the same, you're probably right. I know that's hard, and I know most people are probably not going to do that, and probably end up doing a lot of what I do. That's one of the reasons that even as a financial advisor, we have people that work on teams, and my favorite team is actually at Fidelity. They call it the Silver Team. And anytime we come in, it recognizes our phone number. And because we're an institutional client of Fidelity's, it directs us to one of those 7 people. Those 7 people, then, if they don't know the answer, can redirect us out to the people in the departments that can get the questions answered. And I get better service there than I did from the firms that I used to work for directly. So it's pretty mind-boggling, and I've been very happy. It's one of the reasons that I have stayed out independent for so long, because we have a huge amount of support. The support, like I said, it's better than the support I used to get when I worked directly for the companies. So, and we're always working on stuff. I've got stuff that I can't really talk about right now. All I can do is say it's going to help pretty significantly. It will help everybody kind of stay on track, and I guess that's about the only hint I can give from that. So, it's going to take me a long time to learn this. It's a software package, but it's very beneficial. So I'll just tease you with that, and then I'll leave you alone. But if one of the things I laugh about this all the time. I see financial planners and investment advisors and the financial representatives. A lot of people like to make this really complicated. And you know what? You feel free. You can do that. There are thousands of pages in Internal Revenue Code, thousands. Okay, and there are thousands of pages written in books on investing, and you feel free to make this as hard as you want it to be. Me, I kind of like to keep things as simple as possible, because keeping it simple when everything is complicated, that's a skill. And you're less likely, in my opinion, to make mistakes if you're trying to simplify. How do you simplify? Well, you got to do the data gathering. That's rough. That's the reading and asking questions and whatnot. Then you have to see what your own situation is and how this may affect you. It may not even affect you. A lot of things don't affect people here. If you're looking at, I've got to take my RMDs out at 72 now, just changed. And but you're 68. So that may not, and that's not a really good example, but there are times when there are things that you're not going to have to worry about. And again, one of the things I really like about this business, it's never boring. I mean, I get questions all the time, and I'll go talk to my crew. I'll talk to the vendors that I work with. They're the largest custodians in the world. I have a couple of attorneys and CPAs I've been working with over the years. Tax preparer who's got the highest license that you can get. And now I see I've got a phone call here, so I'm going to take that right now. By the way, if you want to call 330-664, I'm sorry, I started giving you my home office number. It's 216-901-0945, 216-901-0945. And I got Joe in Seven Hills. Joe, what are you up to this Saturday morning?
Well, as usual, like going to church, I'm listening to Bill Bullington on the radio.
Okay.
Bill, I have enjoyed you for at least 25 years,
Wow, I really appreciate that.
I met you when you were at your original big place downtown Cleveland, but I didn't know I met you. Your name just appeared on one of those statements as my representative. I don't think we ever talked.
Well, that's fine.
You had a girl assistant at that time, but anyhow, that's a long time ago.
Right.
But I want to agree with you about Fidelity.
Yeah.
I've done my own research, thanks to you. You've made me I think a smart person.
Well, that's good.
I've done my own research on my retirement with mutual funds, and dealing with about 11 or 12 different mutual fund families, with about between my wife and I having about 32 different mutual funds in our retirement plans.
Holy cow.
Yes. Talk about diversity. I like to think.
Well,
but anyhow,
right.
Fidelity, you're absolutely right, Bill. They're unlike who's some of these other ones? T. Rowe Price, Matthews, some of these others that I dealt with.
Right. I also use a company called Axos. They bought out old E-Trade advisors. E-Trade got bought out by J.P. Morgan, and so they spun this company off. And their platform's super nice too. And it's actually visually, I think it's a little nicer than Fidelity. Fidelity can get a little confusing from time to time, especially when you're logging in to their website. There's a ton of stuff on there, and it's great, but they keep moving it around, so you have to find a different way to it. But no firm is absolutely perfect. But if there was one, I'd say both Fidelity and Axos. Those are my top two picks.
You mentioned something about, I don't know, this term about their websites. I'm a guy that doesn't do websites because I can't navigate through all this drop down here, drop down there, over in the right-hand corner at the bottom of the middle page,
Right.
When I call Fidelity, they answer their phone 24 hours a day, 365 days a year, period.
Yeah.
Even for me. And I'm not paying them anything like you are. And I think I get the best service from them. Also, they're not on banker's hours like all these other companies are.
Neither
the
are
stock
we.
Exchange. I know it. You guys are terrific.
I have my phone with me right now.
I used to pride myself in real estate also, Bill.
Yep.
When I was selling foreclosures here in Northeast Ohio, I had a Cleveland call me one time at 2 o'clock in the morning. And at that time, it was before the internet.
Right.
So I was faxing out my lists, of foreclosures at 2 in the morning. This cop calls me. He's on the beat. He saw my sign in the window. He calls me, and I answered the phone. What do you answer the phone at 2 o'clock, he says.
That's fine.
Well, I like to pride myself,
Yep. Oh,
that I answered. And go ahead.
By the way, the Fidelity also has relationships with Vanguard and BlackRock. And so we're not limited to Fidelity's products. I just want to make that clear. And we don't have to, we have options. We have institutional options for fixed income that are just awesome. I mean, Fidelity is one of the largest fixed income managers on the planet. And we have a special platform that we use because we're institutional. And it's really nice. I can't say enough about that either. But go ahead.
It's got to perform a whole lot to be as nice as the Bullington Capital organization is to me. I have to tell you that. And when you say there's no pressure, you're absolutely right. Sometimes I'm a little, I haven't talked to you that much over the years, but when I do, you always respond very well, and you're talking about no pressure. You're absolutely right. I want to make a commercial for you.
Oh, thanks. I appreciate it. But
I'll hope to be talking to you this week because I got some issues I want to talk to you about.
Okay, that sounds good.
One other thing too. Moody's recently downgraded the United States banking system.
Yeah.
What the heck is that?
It's pretty meaningless. I mean, realistically, when you as a country, when part of your country's banking system puts into law that you could literally print the money and distribute it, that means why would you ever go into default? It doesn't make sense.
Right.
Now, if they did that, that would be highly inflationary. I mean, that you'd be back to like 70s inflation rates. And
we're in the Biden years now, so that's happening.
Well, you never know. And it's happened pretty equally on both Republicans and Democrats. So,
really?
Yeah, absolutely. There's only like a 1% difference in the returns on the stock market if you add up every Republican president and every Democratic president. So my advice is don't pay any attention to that. It's distracting and it doesn't help. It's only going to hurt you.
All right. All right.
All right. Well, hey, thanks for calling.
Thanks.
Have a good weekend. Bye-bye.
Keep up the good work, man. Bye-bye.
Yeah, I just, that's pretty funny. I lost my whole train of thought. You know what I was going to talk about? A lot of people don't really belong in stocks. I mean, they don't. And a lot of people, like me, got 70% of my money in the stock market. And because not quitting anytime soon. When I get to within, I don't know, 10 years, maybe I might start to hold a little bit more fixed income. But for now, I've got mostly that fixed indexed annuity from Nationwide that I talk about every once in a while. I have that. And I've got I've got a lot of my money in a bond ETF that's managed by Fidelity, and I got a phone call here that I take real quick. If you'd like to come in and join the show, it's 216-901-0945, 216-901-0945, and I'm going to Kenny. Kenny, how you doing?
Real good, Bill. It sounds like it's Seven Hills Day. Everybody's calling in from Seven Hills.
Yeah.
We're all getting older. Question I have, fixed annuity for a daughter or a grandchild. Daughter's 38, grandchild 7.
Okay.
How does that work if you wanted to buy it for someone young? Because I don't need it.
Okay. There is a type of product that's relatively new. Okay.
Okay.
How old is she?
Daughter's 37, 38, grandchild around 8.
Okay. So what I would probably do, there is an investment only variable annuity. It's got it has schedules that you can put riders on it, and you can add riders over the years if you want to. Riders are basically little insurance policies that do things like guarantee income and that sort of thing. But because she's so young, I would probably use a variable. That's an annuity that's got mutual funds inside of it, and Vanguard, T. Rowe Price, Fidelity. The ones I use, they've got all the big names there and the best performing funds. They've got models that we run our own model, but you can choose from their models too. And
variables. Just so I understand, Bill, variables have fees. Fixed annuities don't. Is that correct?
No, they all have fees. There's no insurance product out there that doesn't have a fee in it, and they can call it whatever they want. A lot of people, but that's my feeling. So, I like if you're looking for tax deferral and some guarantees on the principal, that's a good idea for somebody who is your daughter's age. It's going to grow a lot more. The fixed annuities are generally for people who are probably 60 or older, I'm going to say, because you can start getting close to retirement and you don't want to see the fluctuation of the stock market in all of your assets. So in the older you get, the lower your life expectancy is, the less you can afford a big drop in the asset value. So that's when the fixed and the fixed indexed annuities become very useful, because you can take a big chunk of that money and you can guarantee, they'll give you a minimum guaranteed return on it. And it's a contractual agreement between you and the insurance company, and they have to, they're not allowed to break that contract. You're the only one that can. So
if you're to die, Bill, and you have this in, what happens? Does the money just go to the insurance company?
No, it goes to a beneficiary, and that's another thing. It depends. If you took an annuity that's called a life only annuity, what a life only annuity is, you put $100,000 in there, they're going to give you $6,000 a year for as long as you live, no matter how long you live. But when you die, the money's going to go back to the insurance company. That is not a popular option. And they have others that will leave money to the beneficiaries. So if the annuitant dies and they were taking income, they'll take a look at whatever the cash is in there, and they'll give you a percentage of it up to 100%, depending on the company and the contract. And so you don't have to disinherit your family. And in the old days, when I first started in this industry, that was it. I mean, you had two choices: just keep it the way it was, or you had to annuitize it. And once you annuitize it, that meant turn it into a monthly income. And you died, the money went back to the insurance company, not to your beneficiaries. And a lot of pensions used to work that way, and some of them still do. So you have that's the one thing that I kind of, it's fatiguing because they're always changing the rules.
Right, the tax system, right?
And we have to go to, yep, and we just the annuities, by the way.
Bill, that's why you have continuing education
yes,
credits. Right?
Exactly. I was going to say, and you know what annuities are? They're 24 hours every 2 years. So you're doing like 2 hours a month. Yeah. But hey, I hear the music. That means I got to take a real quick commercial break. Did you want to hang on? Or
okay.
Are you good?
No, you got it, Bill. I'll call your office sometime.
Okay,
thank
you.
God bless. God bless.
And we're back. This is Bill Bullington. I'm here every Saturday morning from 11 to noon. If you'd like to get in touch with me, my website is bullingtoncapital.com. You can also email me at bill@bullingtoncapital.com. If you didn't want to get on the website, I understand. Or you can call us, 330-664-0700. That's our office phone number. And then if you want to talk to me, you hit 1. You want to talk to Melissa, hit 2. Gary's 3. And we'll see what we can do for you. You know, I was looking at this. Nationwide's got a website. If you want to go in and play around with it to kind of see what kind of income you might be able to generate, I think it's a good tool. I really like it. I was thinking I think I have a $3,000 deductible on my health insurance plan. So if I were to keep that plan, let's say I got a health plan from my employer when I retire, so I'm not going to be able to get Medicare, or elect not to. But I've got a $3,000 deductible and a $7,000 $3,500 deductible, $7,000 out of pocket for family. That's very similar to the one I have. I might put the money in this annuity, $100,000. At 67, I'm going to turn it on. It's going to pay $7,154, which is a little bit more than what my copay is on my insurance. So I set that up to fund the copays on the insurance. And I got that idea, by the way, from one of my clients. It wasn't me. The client called in and said, "Hey," and I was like, "Well, that's a good idea." Yeah. So it's funded then, and if you're not using it, it goes into an account that just accumulates. And right now, I think the money markets are paying more than 4%. I'm pretty sure they are. So yeah, it's working out. That can work out really, really well. That money would be there then for your copays and deductibles, and you're all set. So there's all kinds of things you can do. You know, it's kind of funny. Sometimes it's a little bit exasperating because somebody says, "Well, what are all my options?" And I'm like, "Wow, how much time do you have?" The bottom line is you can do almost anything you want. Not that you should, but you can do. There are a lot of things you can do, and you've got a lot of options. That's probably one of the biggest problems with today's life is look at all the options, all the choices you have. And there's this, I forget what it is. There's a psychological term, and I got a guy I think he wrote a book on this. It was one of the subjects in the book that he wrote. He's a psychologist. But when you're given way too many choices, and what's really interesting is a lot of them are high quality choices. So you're given a lot of high quality choices. How do you decide? And the reality is, that's when just talking about it. Well, if you do it this way, then this could happen, and this is how this would play out. And if you do it this way, then this is going to happen. And if nothing happens, then you've planned and you're okay. But I get a lot of people that want to know the future, though. Well, how much can I take out and to be assured that I'm going to run out of money on the day I die? Now, I kid you not. I had a client asking me that question for 10 years before he finally gave up. And you know what? I think he just got fatigued. He was thinking about it. He wanted to plan it so that he would run out of the money the day before they took him to the morgue. Seriously. And he knows we're good friends. I just thought, and it was after a while, I was just like, after the fourth year, I was like, oh, this is funny. I think he's doing it as a joke. And so I would put down, here, if you live to this amount, but here's the problem with that. If you live too long, and that's one of my problems with financial planning, especially that cash flow based financial planning where they try to do a budget. And, you can do a budget and then your car is going to break down, and then your dishwasher is going to break down, and something's going to happen. Somebody's going to drop something on a floor, and you got to get that fixed, and just life. So I'm much bigger at, like, say, a goal based planning approach where I want this amount of money because I know if I take out, say I get $1 million and I'm going to take out $45,000, I should be safe. $45,000 plus everything else I have, my Social Security, any pensions I might have, part-time work. That's a really good lifestyle. Heck, $500,000. If you've accumulated $500,000 and you take out $20,000 a year, you put that on top of whatever it is you're doing, or other stuff that you're getting. That's kind of where you should be. That's actually the 4% rule in practice. So $1 million, you take out $40,000. Now I know that doesn't sound like a lot for a lot of people. They go, "What? What are you talking about? You have $1 million." Yeah, I know. But if you take out more than, and by the way, that's what you start with. 10 years from now, it's going to be, $6,000 because of inflation. 20 years from now, it's probably going to be 100% of what you took it at. It's going to be 8%. Why? Because the cost of living rises. Okay, so that's kind of the recommended, somewhere between 4 and 6%. That's the recommended withdrawal rate. At 6%, you are pushing above the maximum. Pushing the maximum. So you got to be kind of careful there. And anyway, you know what? I've only got a few minutes left here, and I think I promised I was going to talk about individual stocks because I like to do that. I don't do as many as I used to, but I'm telling you before I buy this one, which keeps me really safe based on SEC guidelines as an advisor. Amazon comes up on a short-term momentum scan that I run. I haven't seen Amazon on a short-term momentum scan for decades. I mean, it's wild. So what's a short-term momentum? It just means that if we look over the past 90 days, Amazon's outperformed 80% of all stocks. The past 90 days, Amazon's outperformed 90% of all stocks. Now, the all-time high was $185, and that was back in July of 2021, and it's at 106 today. Okay, so that's a big drop. I mean, if you had 1.9 million and now you're at 1 million, are you upset? Probably. Be honest, you're upset. But its valuation, looks like the price to sales ratio on it is 1.6, and at some point in time, if you want to talk about it, you can come in and talk about it. And COVID came along, and I moved buildings right across the street, about 75 yards from my old building. The building I have now has a little meeting room in it, and I haven't forgotten about the couple of investment clubs that want to try to get together. So, because it's fun, it's interesting. I didn't see Amazon would come up. I have one small account makes up a tiny percentage of my net worth. That's why if I lost everything in it, be like, oh, well, it's a bummer, but that's the way it goes. And the chances of that happening, by the way, are extremely remote. And I'll talk more about that on next week's show because I don't have time to talk about it on this week's show. If you're going to be in stocks and you want to, if you want to devote some time to it and you want to have a little, I think it's fun. Even when I get stopped out, I'm like, oh well, I'm glad to be out of it because if I do get stopped out, it meant that it wasn't going to be a fast mover. Okay, so, but Amazon came up on one of the lists. I thought that was really interesting. The other thing is that the first three, there weren't too many. Friday was pretty slow. But one of them was DaVita Healthcare Partners. The symbol is DVA. It's got a nice looking chart. It was around $135. It looks like third, fourth quarter last year. Right now it's 86. It's got a short-term relative strength ranking of above 80. Closed at near the high of the day. The volume was above average. So the price to sales ratio is 0.6. That's pretty good. And if none of that means anything to you, don't worry about it. In fact, this is like, I don't know, it's like ice cream. It's addictive. That's what I guess I'm trying to say. So when you start looking at these things, but those are good, solid companies. I haven't seen this for a while. I haven't seen companies that have good valuations, that have good underlying businesses. When I say good, what I mean is the valuation part, it's lower than average. And the good business, they're businesses that are profitable, that have been profitable. They may not be profitable now. I haven't had time to look at them. But at some point in time, they had earned profits. That's a big deal. Okay. When I'm seeing multiple companies in one industry, the first three that came up were healthcare. And the fourth one was Amazon. And the fifth one is Medtronic. The last one is Las Vegas Sands. That's pretty funny. Got the hotel, the casino in there with healthcare stocks. Well, I guess if you lost too much money and passed out, you've got to go to one of the healthcare organizations. I'm just kidding. But anyway, so those look pretty good. If I were to be buying stocks, that's probably where I'm going to be buying from. That's where most of my stocks come from. There are two different types. I don't have time to explain that, and I apologize. I'll get back to this on next week's program. In the meantime, the long-term planning stuff, we're going to try to hit that a little bit more each week. What should you be doing? What should you be looking at? What looks attractive right now? And the stuff generically that looks attractive are growth stocks. They do look attractive, but I got about 10 seconds. That means I better close up. This is Bill Bullington. I'm here every Saturday morning from 11 to noon, right here on 1420. Have a good week, everybody. Good luck and good investing.
Just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullington Capital Management, LLC.